Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. Our next topic here is trading price patterns, and I'm your host, Kevin Horner. Of course, I am stepping in for the next month and a half or so for our friend Barbara Armstrong as she recuperates from knee replacement surgery. So happy to help everybody and certainly happy to be here with all of you. I'm glad you're joining me today. We have Brent Moores in the chat. You can say hey to Brent there. He'll keep an eye on your comments and questions. But in this particular class, I am absolutely interested in hearing from you. I would like to address comments and questions on the fly, so please feel free to post for the duration of the show. We'll probably go about 40 to 45 minutes, the charts depending. Of course, we'll see exactly how much content we have to provide, but I've got a number of symbols that we're going to look at today, a few different considerations for you, but we're going to lean into some bull flags and perhaps falling wedges. We're going to talk about maybe the difference between those a little bit and how traders might set up trades for themselves in that process. So I'm going to try to give you all, as usual, a few points of interest and some things that are concepts that traders might choose to employ, some things that you might take away today and build into some of your example trading or your paper money trading as you're working through figuring things out here in the market. So let's get down to business. Let me bring up the disclosures and we'll start talking about the fun stuff. So first of all, remember that our conversation here is exclusively for your information and your education. I'm not making any recommendations, of course, with any of the symbols we utilize today. So bear that in mind. Of course, we will discuss technical analysis as part of that discussion, but what we're going to be doing in regard to technical analysis, of course, is providing insights and thoughts, things that traders might choose to consider and use in their own process of trading. Now, additionally, in this class, we will likely be relying on options as we build some of these trade concepts for examples. So you need to be aware that options carry a higher level of risk. They are not appropriate for all investors. In order to trade options at Schwab, we ask you to be approved for each individual account in which you would like to trade those options, and keep in mind that you can maintain separate approval levels over your various accounts. But you'll want to familiarize yourself with characteristics and risk of standardized options. We can get you a copy of that at any time. You can call us for that. You can also go to the CBOE website as well. All right. So in terms of our process today, that's pretty much it. The one takeaway I need to be making certain that I remind you of course, is that if you are working in a paper money platform, one of the things that we will not see occur is you will not see the early assignment of a short option. This is not something that we can prepare for with paper money, but it will be something you need to be aware of that can occur in a live trading account. So recognize that anytime you sell an option, you have the obligation for that option. That means you are either going to be required to buy stock or deliver stock, one of those two scenarios, and it can happen in advance of the earnings when you're trading regular style options, that is to say America style options, so which trade most commonly, basically the equity options that we'll be possibly discussing here today. Okay, so we're going to jump right in, everybody. We're going to look at, like I said, a number of charts and try to cover a few different concepts here today. I thought we would start with a look at some of these. Now, these are not going to be stocks that you're not, many of these stocks are going to be stocks you're all kind of somewhat familiar with. It looks like I've got Micron on the chart here today. I thought, why not? Let's start with Micron. I have an open order out there. As it turns out, this was from a class that I have just recently picked up, our After the Close class. I've had some difficulty hosting this class, even though I've picked it up recently due to my travels. But the last time I pulled Micron up in that class, we were looking at a buy limit order. We tried to be buying this on a dip. And since I've placed that buy limit, it's just sat out there because we've not been able to gain execution on this trade. And so that's why you see the orders sitting there, everybody. A buy limit with a subsequent sell stop in the instance that I was to get hit or take on those shares. So what we're going to do here is quickly migrate over to my monitor page, and I'm going to just cancel this buy order and the subsequent stop. We're going to just move on from that, and we're going to start a new example trade based on how the chart is acting right now. And the pattern, I think, that is most obvious here, everybody, as I zoom in, first of all, let's all make note of the fact that Micron had been below the 200-day moving average for quite a while here. As you can see, we've had a few rejections, 2-3 days above the 200-day, and then maybe we meet the 200-day and fail. But I found it pretty intriguing how each of these were matching highs back here and fails. Not new, couldn't even bust through and make a new short-term high. And then we follow that up with failure and rejection at the 200-day once, twice. Here's a third rejection, then a fourth. And then we finally get to a window where things are changing. And the possibility for a rejection existed here. But as you can see, everybody, instead of getting rejected at the 200-day, we really consolidated at the 200-day. And what did that allow us to do? It allowed price action to get caught, or what I should say, allowed our moving averages to get caught up with our price action. And you'll see how the 20-day moving average really started to take off and slope up aggressively, better than a 45-degree upward angle here, everybody. And that 20-day moving average has still been held by and large on a closing basis since then. So what are we looking at in development here of the trend today? Well, we have seen that after a wonderful push to new highs here in the short run around 130, we've taken a little bit of a breather. Many traders would suggest that this is looking, didn't mean to zoom out, let's zoom right back in, there we go. Many traders would suggest that what we're looking at here over the last 2 weeks is a very basic bull flag. Why is it a bull flag? Well, we've made a really nice long run from the breakout spot here and made a new high with very limited give back. And obviously the recent test here over the last week at the 20-day moving average stands out. But if I applied this 10-day moving average in lieu of the 20, let's make it a 10, 20, and 50 here instead of a 20, 50, and 200. Let's just look at these shorter terms real quick. I'm going to zoom right back in and see how when we broke out of this little 2-week consolidation, we started to trend and trend quickly. And we traded above the 10-day moving average for the entirety of that until we got to the breakdown day here on July 1. And granted, we have held the 20-day thereafter, so some traders will use a combination of these two speedy moving averages to define the trend for themselves. And if you were simply the buyer who said, yeah, we got a breakout, I'll stick with this at 99 until we close below the 10-day moving average, you probably would have stuck with it till at least the 30th and maybe the 1st. But if you did so, even buying at 99 and getting sold out on the 1st at the low of the day, it would have been around 119 and would have been about a 20% move. Not a bad way from a trade management standpoint to manage that trade. So if you'd have traded it that way, congrats, wonderful setup. Now, where are we today? Well, today we've got the potential of a broken bull flag leading to more upside. Now, this is a tricky one now because as I reset my moving averages to my standards, 20, 50, and 200, the intriguing thing is you've got a really red candle today, a red candle where we tried to break out, right? We tried to move higher and couldn't. In fact, intraday, we traded above the high of yesterday, and we've seen a bit of a reversal. Now, some traders will tell you they're uncomfortable based on today's candle. Other traders would tell you doesn't matter because we're outside of the 2-week bull flag pullback here, or maybe a week and a half. I think we made the high here on the 26th. So we've got 1, 2, 3, 4, 5, 6 sessions is it. 6 pullback sessions, found support at the 20-day. And now you've got 1 day outside of the flag and day 2 outside of the flag. Some traders would be a little nervous. Paul, I understand it. An engulfing candle potentially today. Too early to call it such just yet, right? Because we're not at the close. If we were to close below the low of yesterday, some traders would say, yeah, it's a bear engulfer, but it's a bear engulfer not at the end of a major rally, meaning it's not like this one, right? This looks like a bearish engulfing candle because we were higher and closed lower, engulfed the entirety of the day before. And yes, it led to a pullback, but not to this point a reversal. So if you're the trader who looks at this and says, I've got 2 days outside of the flag and we're holding the 20-day, you might want to wait for today's close to confirm it. You don't want to necessarily see a close below the 20-day today. So that makes sense, Paul. Yeah, make sure you sit on it, wait for the 20-day to maintain. Or maybe we get down and test the 20-day today. The low of the day could be on the 20-day moving average, for example. That would be 121.52. Our low today is 122.23. We've missed it by about 75 cents. But the point remains, outside of the flag is more important than maybe what has occurred here today, at least as some traders would look at the price action. And so they might feel confident developing a new trade, recognizing that we've been above the 20 days since April 24, and we have not closed below it since. I mean, did we get close back here on Monday? Let's see. The close was 119.92. Yeah, so we were below it by about 25 cents. All right, and yet we've closed the next day above it. Some would call that a close above the high of the low day. Could be a buying opportunity. Okay, doesn't mean it has to be. Why don't we talk about it from a setup standpoint so that if we were the bullish trader who said, yeah, we're outside of that flag, today's action's less concerning. The fact that we're above the 20-day and outside of the bull flag to the upside, that is, broken it to the upside rather than trading below the downtrend line here, that's the most important thing for many traders. And so they might set something up here. Could you go with a long equity position with an exit strategy below the 20-day? Absolutely. How might that look? Very basic, right? Some of you would say, hey, if I'm going to do that with equities, that's cool. I'll buy 100 shares. Maybe I need to incorporate the average true range to ensure that I don't stay with a broken down trade. And so they might say, hey, let's use the 20-day moving average at 121.50, and let's go beneath it by the amount of the average true range, right? Because that would be about today $4, and I'm going to use round figures for our ease, everybody. So if our 20-day is 121.50 and we go below it by $4, then we come in at 117.50, okay? And that becomes our exit strategy or our downside target for a stop order. Interestingly enough, at 117.50, you would also trade below the low of our pullback here. This day, July 2, represents the low of that pullback. And for many traders, they want an order to exit that would trade through the low of the pullback. That would give them confidence that a trade is, that a breakdown in the price action is more likely to continue than to continue upward, rather new trend being to the downside if you move below the 20-day. So this is just giving a little bit of wiggle room, right? So a trader could set that up with an equity position and a stop below this low. And again, the math that I used was the ATR of $4 below the 20-day moving average at 121.50. And that comes out to about 117.50. So just a quick example of how we could place that, everybody. If you were comfortable being a buyer today, let's do it for a smaller portion here, about 50 shares. And then there we go. And we'll do this as a market. And again, these are not recommendations. These are reminders of how we go about the process here. So we'll just do a market purchase, which we know can only happen good for the day. And then we'll do a subsequent sell stop good till canceled. And we will put that in at our 117.50. Many of you will say, yeah, Kevin, I appreciate the 117.50, but we're going to go beneath it by a few cents here to get off of that round figure. So keep an eye on that. Maybe, maybe you don't want the round figure exactly. You like to get a little odd in your calculations. So again, we're just looking at the potential here for a broken bull flag to the upside. And the pullback you're getting today could be negligible. It might not be tied directly to Micron. Taking a look here, the headline I've found is kind of limited, right? We had a headline there yesterday. We had on Micron specific, but not on, now here's a headline that could keep you a little bit nerved, I guess. CEO warns of demand pull-ins. That's a little bit of a heads up. Again, we're not talking about this as a purpose from the purpose or standpoint of, hey, this is a great trade you need to take. It's merely an example of how some traders might work with a bull flag and consider trading it, given that we were outside of it for 2 days. So we'll go ahead with our stop exit at 117.44. So we're going to have a little equity position here right off the jump in over the next few weeks here, everybody. The last thing that I need to do is make sure that I apply that from my unallocated position to my trading price pattern so that I've got it as an easy thing to monitor. So I'm just going to right click here and move it to my trading price patterns group. And that's where it will reside. And then we can check on this one for you all over the coming 6 weeks. The stock did go ex-dividend on the 7th. So 2 days prior, Monday, is when it got its adjusted price. Remember, though, the adjusted price is relative to the amount of the dividend to be paid. In this case, it looks like about 11.5 cents. Not a huge amount of the dividend, certainly relative to the price per share. So bear that in mind here. Okay, so there's one example. One of the other things that I want to talk about today is maybe the difference between what could be considered a bull flag, like you're seeing here in Micron. We also have a bull flag in Coinbase. Let me take a look at Coin for you all. And we might be in the midst of breaking that here today. Let me clean up my drawing set here. We're just going to put this all back to a 1-year chart. And looking at what we've got most recently, everybody, we've got a couple of notable developments here. I'm going to go just to the low we have seen. The stock has made an incredible push, right? From 142, we got to 382. We were up more than, 168% over that window of time. 56 bars, that's 56 sessions. That's not a long time. Less than 3 months, and it's up 170% nearly. Fantastic move. But what stands out from the chart standpoint, something similar we saw with Micron, right? We've got a little bit of a consolidation after breaking out. And then we got this gorgeous candle with not just gorgeous candle, but gorgeous volume as well at the time. Now that volume, as you can see, has really lightened up. Why has the volume started to lighten up? Well, at some point, the volume starts to lighten up as we go downward or consolidate. But it's notable that Coinbase, for many traders, probably it was here last week where they said, hey, we broke that bull flag and we could possibly consider getting into this again based on this day here, the second when we closed above the downtrend line. And you'll notice that while we have managed to stay above the downtrend line, some of our lows have still tested this 347 zone here. Could, given what we've seen from everything, we got a couple of key details to make note of. So we've had a nice consolidation that lasted about 3-4 weeks before we broke out. Good indication of new price level being achieved, potential for new trend. We've got a rising 20-day moving average. We've got a 50-day crossing a 200-day. These all speak bullishly, as does the volume in the pullback here, lightening up as well. Now, granted, we've gone a little bit more sideways and some of that volume has shaken itself out already. There's not been enthusiastic buying over the last week, as you can see, because the volume spikes have been relatively limited. But if you were looking at coin and looking at the action of the last 3 weeks or the last 4 to 5 sessions, pardon me, as validating the broken bull flag here, well, then traders might consider setting something up using maybe this zone here, this 347 approximate low, and starting with potential for a new trade right from here. So, looking at 347 as support, 347 down to maybe 340 or so, this is a large dollar position, so you might find yourself needing to give it a little bit of wiggle room. I wanted to answer your question here, Paul, about could you wait for a hold? Well, technically, if we zoomed in, everybody, we've gotten a hold, right? The low day in the pullback was here on the 1st, and the high trade that day was 353.40. And so once we got a close above 353.40, some traders would have said that's the hold move I was looking for, and they may have started a position. Then if you notice here, the closes over the last week, we've had a 354 and a half, a 355, a 357, a 354.80, and to this point today, a 363.30, our last trade. All of those are above the high of 353.40 on our low day in the pullback. So some traders would tell you, hey, I was waiting to get in for that first hold move, and they liked it, and they may have stepped in on day one. Other traders would have said, Kevin, that doesn't meet my definition of confirmation. I need more confirmation. I need a day two above that level, closing above the high of the low day, or day three. Well, whatever that is, you've had 5 days now consecutively closing above the high of the low day. Some traders would say that's more than adequate. And so, yeah, Bruce, I was thinking here, Stay Gold, pardon me. I was thinking that while Micron, we start with an equity trade, let's build a long call vertical here, a spread where we can participate in upside opportunity, but be willing to cap our upside by a certain amount, because that'll help us to reduce the cost on our trade. You can absolutely allow for just a simple long call where you don't cap your upside by selling another call at a higher strike. But we're going to build it as a long call vertical with a long strike price and then a short strike of a number of points out. Probably looking at somewhere in the neighborhood of a $20 spread, just based on the price levels we're looking at. Recent high was 382. And if we're trying to just be comfortable and not aggressive, something that a trader might look at is that prior high and say, I know as a trader, I should be targeting 380 approximately. Well, then that might work out. But what's nice about targeting 380 is that if it finds resistance at the prior highs, your trade can still work out in the short run if it runs to that approximate level, even if it gets rejected, assuming the trader is prepared to take action when it gets there, right? So what levels might you all be considering if you wanted to be bullish here on Coinbase? Recent support falls between, like we said, 345 to 350. The question is really about how much risk the trader wants to take on, right? And in looking for a $20 spread, subsequently, the question should be, does the trader have comfort for buying an in-the-money call, which is going to be a little bit more expensive, right? So if we were trying to look for a approximately $20 spread with maybe a target at 380, we could also target anything lower than that just to give us a little bit of wiggle room and an opportunity to run, but recognizing it doesn't have to make new highs for this to be a profitable trade. That's just one key thought process I think that some traders probably are considering. So we might look at something like a 355 to 375 spread. So let's take a look. I'm going to write this out as 355, 375. Now, admittedly, we're going to be at least 8 points in the money, so it's not going to be cheap, right? But that's the reason for selling a call at the same time. As Brent is pointing out here, you buy the lower strike, you sell the higher strike, utilizing the same expiration, but it reduces the cost of our exposure to the trade. So let's take a look at how that'll play out, everybody. We're going to go a little further than we normally would. So, we're not going to look at this week. Next week is an actual monthly expiration, and that might be one of the more active. You'll notice in here, when you find open interest on the call side, you've got a few thousand contracts in some of these various strike prices. So that can give you some consideration there. Looks like I need to change this. There we go, to purple. Okay, so now these strike prices look a little bit more appropriate. So we were saying 355 upwards to 375. So how might that look at this point? So we are going to start with the 1830. The easy way to do this, I think, is just to click on through. So you click the call that you want to buy, hold down your control button, and click the call you wish to sell on the bid. and then it populates. So that's one way of doing it, right? An alternative to doing it that way is to click here and right click and say, I want to buy a vertical, okay? And then you can build it right from here. And you can always, as a reminder, make adjustments down below. Remember, anytime you see the little triangle or caret in the lower right corner, that's an action definition for you, okay? So you can absolutely play that way. You can make your adjustments along the way. So yeah, it would cost you $1,840 just to buy the call, but by being willing to cap your upside to $375 and only make a $20 spread out of this, you've reduced your cost in half by being willing to do just that. And so now your opportunity is $900 of loss as compared to $1,800 of loss. Many traders would find that to be an appropriate amount of give up when thinking about spreading it off more so than simply just speculating and owning a long call. That's why we're talking about it in this manner, okay? Seeing here about some of the questions. Yeah, you know, again, James, I understand where you're coming from. Reminder that when we're talking about trading the market today, I am much more concerned with looking for these opportunities and following price patterns. I can't build in the analytical viewpoint that I normally would in a trader talk conversation, for example. Today, our conversation needs to center exclusively on locating patterns and how to trade those patterns and ways that traders might go about doing so. Doesn't mean that now is the right time for it, but I got to give you some examples. That's why we're doing it here this way today. All right, so we're going to go ahead and follow through on this spread, everybody. I will point out, Stay Gold, good question about why not move out. Hey, there's nothing wrong with going out another month, except for your cost will be notable, right? The $350, there is no $355 to go out a month. It's now $10. So then you got to go maybe $350 or $360. Now we're looking at a $3,200 long call at the $360 and maybe a 20-point spread at the $380. You can absolutely do that. It's still, I'll point out, if we made this adjustment, went to the August 15, changed this to 360, 380, the cost is not going to be a whole lot different, everybody, because, hang on, if I can at least make my strike prices match the way I want it. There we go. You can see they're not going to be a whole lot different. This is actually going to be a little bit cheaper, but you are adding time to the trade, which might force you or make you feel as though you need to give it more time, right? You may not want to. Remember to consider your time frame not for necessarily the trade, but how long you want to be in the trade, right? So make sure that that's part of your process. We could absolutely go this way, but I think if you're a trader and you're looking at the chart definition of what we've seen, the resolution of the pattern we're trading should happen in the next 7 to 10 trading sessions. And I don't think that there's anything wrong with trying to keep it tight to that window. If you want to give yourself a little added time in the example trade, you absolutely can do so. For our purposes, we're going to stick with the July 18 expiration. We are going to stick with my 355, 375 for a $20 strike or $20 spread. And I'll remind you the easy math on this. Remember, the opportunity for profit is the amount of the spread, in this case, 20 points, less what we spend on it. So we're going to spend $9.30. That means that we can make $10.70 as our max gain on the trade. Okay? So that's what we're going to do. We're going to try and actually we're going to go to $9.40, see if we can't put ourselves in the midst of this in this spread order right away. So we're just going to buy one vertical, expiration July 18. And of course, for my side of things, this gives me the chance to talk about it with you all next Thursday as well. So it's still going to be hopefully live come next Thursday. So we'll send that off. Hey, we got executed. That's great. Let's go back to my monitor page and let's move that into my trading price patterns group. We are ready to rock and roll. All right, great. So now we've got a long equity and we've got an option trade also on a bull flag breakout. Now we're going to look at a trade that's going to be a little bit similar, okay? A little bit similar. However, one of the things that I want to point out on CoreWeave is maybe the difference between what you might consider a bull flag and what you might consider a falling wedge. They can be traded very similarly, and yet you might not be prepared or even familiar with the differences. They are very much alike in terms of their nature. What that means is that a bull flag is expected to resolve bullishly. A falling wedge is expected to resolve bullishly. Both of them commonly experience a decrease in volume as we form either the falling wedge portion or forming the cloth portion of our pattern, okay? So on CoreWeave here, we did have a bull flag. I'm gonna have to draw this in for y'all. A nice little bull flag, or some would say maybe just a pennant, right? And that formation led to a breakout, and the breakout occurred. I'm going to duplicate my oval here. Boom. So some traders would have said, I have a trade to make based on this close outside of the bull flag downtrend line off highs. Okay. And they may have taken a trade there. That could have resulted in a very quick move. Maybe it was 10 to 15 points to the high at 187. But what has developed since then is the drawdown looks a little bit too long in the tooth to now be considered a bull flag. In fact, now you are getting to about a 2-week pullback, and this looks more like a falling wedge. But again, the differences between these are kind of minute. The process likely remains the same. Both are considered bullish in nature. Both can witness instances or decreased volume. Notice off the 187 peak, volume has been red, but it's also getting lighter every step of the way. That's not a negative for the bulls. It could be considered a negative that we're about 3 or 4 of our last 5 days are below the 20-day moving average. That could be a negative for you, and that would be understandable. But one thing to bear in mind here, if this is going to break down further, perhaps the trader does have comfort for playing an option trade on this because they recognize that the risk is such that it could break down bearishly from here, find the purple 50-day moving average some 30 points below us. That's a possibility. However, think about the possibility that you do that with 100 shares of the underlying stock in lieu of a single option position, which could mean 100 shares is a $15,000 position, right? Whereas you could put yourself in maybe a call contract trade that could cost you 500 to 1,000, and now your risk is dramatically less, and you still have upside opportunity, right? So one other way to be thinking about it. So why don't we look to build an option trade in CoreWeave that believes that this falling wedge portion is going to resolve bullishly? For a lot of you, you'll say, Kevin, I can't do that because we're not above the downtrend line yet. And I wouldn't fault you for forcing confirmation before putting on your trade. I actually encourage that. More important, though, is to know who you are as a trader. How do you want to go about it, right? Are you the guy that wants to, the person who wants to be long immediately in advance of the breakout? Do you think that there's more opportunity here? Over time, you're going to find that comfort. Sometimes you'll want to get started before the breakout. Other times you'll say, yeah, you know what? I've not had good luck buying before the breakout. Therefore, I'm going to wait. Whatever your process is, just give yourself some definitions and make sure you stick to your plan. So for our purposes, we're going to build a opposite trade, opposite from what we've already done. So we have a long equity with a stop order trade. We have a long call spread, a long call spread on coin. What we're going to do here is also bullish in nature, but we are going to do it differently. We're going to instead sell puts here. We're going to go forward with the belief that, yes, we're going to hold this level, but we're going to sell premium and bring in some dollars to the account. And if we get put shares, we're going to take that as a positive because the stock has been fantastic. Interestingly enough, the level of support that stands out for me as I'm looking at this is right around this 125 zone. And if I wanted to check this out, you tell me what you think about this. Just using my Fibonacci's from the breakout level, I just want to see if it coincides. And it's a 50% retracement. And what else is there, everybody? My 50-day. Hopefully by the time I got to that zone, the 50-day would be pretty darn great. So if I was a believer that this is going higher, but also we're comfortable buying shares if the stock broke down, well, this is one way to give consideration to that, right? You can sell puts at a level of maybe 140 and then spread that off to about 120. So we could sell a $20 put spread to the downside. And we could perhaps utilize it in this scenario, everybody, to go ahead and add more time. Because in this instance, if it does in fact break out to the upside, well, then we will capture a greater amount of premium decay over a shorter window of time. And so this makes sense to me to consider adding time to the trade. So what we should do? Well, we've got, I think the range here is probably about either 145 to 125. I think that makes a lot of sense, or 140 to 120, something like that. So let's take a look at the CoreWeave put options, and let's go ahead and add some time. We can go to the August 15. That's going to give us about 5 weeks. And let's just start there. So if we're over here on the put side at 145, so we take the bid at 145, and then we take the ask on the 125s. Okay, we could bring in $1,250 approximately, probably closer to 12, I would bet. So a $1,200 credit here to basically lock ourselves in to be a buyer of stock at 145. Now we would be able to get some protection out of this, right, by having the 125 long put. So our worst case scenario then becomes a loss of the difference. Remember, we're going to bring in 12 on a 20 point spread. That means our risk is the difference, 8 points, about $800, right? Not a terrible trade by any stretch, because you're bringing in money. It is a bullish viewpoint. You think the stock's going higher, but you'd also be comfortable buying the stock if it were to drop. In fact, it would be comfortable buying it as long as it's under 145. And the reminder is you brought in 12 points. That tells me that my break even isn't 145. My break even drops all the way down to 133 in such a scenario. So if I get put shares, yeah, I'm profitable over 133. Okay, that's one way to give thought to it. So let's go ahead and follow through here. Let's put this one on. Double check everything. We're going to sell a vertical put spread, selling the 145 for August 15, buying a 125 put for August 15 as well. We're going to ask for a limit at 12 points in this example trade, and we are going to submit it. There, by the way, there's our breakdown. Our max profit is the amount of premium we bring in. We can't make more than that unless we get put the shares, and we can't lose more than 800 unless we are put the shares. The put option expires worthless, and we are still holding the shares. Then after that expiration on August 15, we would thereafter have downside risk. Thank you for asking, Probability Trader. I'm glad you did. How is this a bullish setup? The main reason it's bullish is that we are bringing in premium for the right to be a buyer of stock at a reduced price. A, we are comfortable being a buyer at the strike price. And B, we actually think the stock's going higher. So yes, we could 100% flip this on its head and buy long call, sell short call above it, just like we did with Coinbase. But I wanted to give you an illustration of yet another window, another time frame, and another bullish concept that could be employed. Remember, as traders, we differ quite a bit. Some of us are always long call, short call, or speculate exclusively. I'm comfortable buying a long call, or I'm comfortable buying a long put, and I don't like to spread them off. Some of you are just like that. But not everybody wants to speculate to the upside or to the downside. They'd rather just say, you know what? I don't know which way it's going. If it's going to drop, I'd be a buyer. But if you look at it like this and you say, I'd like to own CoreWeave on some weakness, and if it doesn't give weakness and I can't own it at these upper levels, well, maybe I can bring in some premium in the meantime and take advantage of that. Yeah, you're absolutely right, Hyena. Thank you for bringing this up. I'm going to send this off. I did not talk about the consideration for earnings coming on August 14. So we have to be aware of that, right? So technically, if we carried this to expiration Friday, we would need to be aware of the earnings coming into play. But if you are a frequent watcher of this segment, you all know how Barb likes to play these, right? She's not likely to stick with these trades for the entirety of the window of time frame. She's much more likely to say, oh my goodness, we are up of that 1,200 we brought in, we've reaped 1,000. More than sufficient. Let's cover that. Let's take that trade off before earnings. We don't need to add more risk to the trade. We've made 1,000 out of the 1,200 we brought in. In Barb's classes, she frequently talks with you all about that. Taking the 50, 60, 80% of your short trade profit, that's common, okay? Nothing to say you have to carry these to their expiration. I'm glad you brought that up, though, Hyena. I thought that's a great point, and I didn't bring it up, so thank you for mentioning it here. So we have looked at 3 separate bullish trade opportunities, all of them a little bit different, but similar nonetheless. Yes, they are bullish in nature, not necessarily going to work 100% of the time, as we know, but I wanted to talk about specifically flags and wedges and remind you that we don't have to be right about the terminology of our pattern. What we want to be right about is how we trade that pattern. And that's really the takeaway I hope you leave with today. All right. Process, thought concepts. I'm a buyer. Am I a buyer in a flag when the flag is still forming? Most likely you're a buyer of the flag when the flag has been broken one way or the other. Yeah, Wiley, you're absolutely right. Barb reminds me of Tony Gwynn, man. She's just out there lacing singles to left and singles to right, a double here, a double there, the occasional triple. But Barb is a big proponent of taking profits when given the opportunity. And if you're a frequent option trader, then you've seen the merit of that concept over time. You know, on a one-to-one trade basis, you're going to see that sometimes it works, sometimes it doesn't, sometimes you leave some money on the table. But reminder, over the long haul, if you're closing your trades for profits on a consistent basis, you're likely doing well over the long haul. So with that, I've got 3 trades for us to monitor. I need to move my CoreWeave trade up into my trading price patterns group, which I've now done. So we've got plenty to monitor next week, everybody. I hope you all have a chance to come back and join me next Thursday. We'll be doing this once more, of course, but thank you all for being here today. Big thanks to Brent, who was kind enough to get some specific details about these strategies into the chat today. That's always very helpful for all of you. But more than anything, I really enjoy hearing from all of you in the chat and keeping that conversation going. It is such an important aspect of what we do on the YouTube channel for all of you. That community, that feel of community is so important to sharing ideas and sharing information and thoughts. This is really what the Schwab coaching process is all about. It is a community of traders who want to continue to improve. That's why we do it. So I really appreciate you all being here. Follow Brent and me on X, Brent Moores CS and Kevin Horner CS. And if you like this conversation, please hit that thumbs up button down below. I'm going to make sure to get this out to the YouTube archive for you as quickly as we can here today or early tomorrow, but that'll help us in the YouTube algorithm for sure. So again, thanks for being here. I look forward to connecting with you all next Thursday on this class specifically, but you will absolutely see me again here. I will be back tomorrow morning for you for Trader Talk on my solo Trader Talk mornings at Market Open Thursday. So thank you, everybody. Hope you all have a great rest of your day, and I look forward to seeing you again real soon.